Hey everybody, it's Mike Weller from the Weller Group at Keller Williams. We're here with Momi Pointer for Momi's monthly mortgage moment. We're going live on Facebook here, so just give me 1 minute to get this going. And I believe we are now live on Facebook, on my Facebook page. So, okay, Momi, how are you? Sorry for the delay.
I'm well. How are you? Thanks for asking.
I'm good. So what's happening here in September? Rates are still low, I think, right?
Rates are definitely still low. Analysts said they're pretty much on par with where they were last year. So again, note to people out there, if you didn't capture the refi last year or capture a low rate, you can still have the opportunity to do it now. You know, don't think you missed the boat because you didn't.
Are there a lot of people out there that you think haven't refied yet, from what you know and what you can tell?
I wouldn't say a lot, but, and you know, my purchase business is really brisk right now, but I would say that in the past week or two, I've gotten probably 3 or 4 new refis. So, you know, there's still people out there that really maybe they didn't have the time last year, or with COVID, you know, with the pandemic and COVID, they didn't think about it. Or, you know, Mike, they could have been unemployed.
Right. So not in a position to refi then, but now back to work and are able to.
And we can't accept unemployment income to qualify you. So I do have a lot of those borrowers where they unfortunately lost jobs last year, or they were in a service industry where, and maybe now that company is no longer in business, which is very sad. But now they're working again and they can do the refi. So there, you know, there's quite a few of those.
There's definitely people out there that can take advantage now. Yeah. So speaking of jobs, people are getting back to work, right? The unemployment numbers.
Unemployment numbers are a little bit lower. I don't know if you saw in the news, but there's a big job fair. Oh, no, actually on the news yesterday, they were talking about people that submitted resumes. I don't know, like on monster.com or Indeed or whatever the sites are, that the sites accidentally did not get them qualified for the job that they were applying for because maybe they didn't put like a keyword. Did you see that news segment?
I didn't see that.
Like, maybe they didn't put, like, let's say you were going for janitorial work, right? And you didn't put that you can buff floors. If you didn't put that key tagline in there, your resume got deleted or trashed and you didn't qualify for that job. So I think with the elimination of the benefits, right, that happened this past weekend.
That went away, the extra 300
in California,
right?
Yeah. With the elimination of that and all these job fairs and more people needing, I mean, there's more jobs now ever than it has ever been, you know, nationwide. I think that's ever been posted.
Right.
People will have the ability to go get jobs and get back in the workforce. So I think it's good. It's good for the economy.
Definitely good. Definitely
good.
Which
means more people to buy.
Just more, you know, more actual money running through the economy, more actual production in the economy. So it's a good economic
productive economy.
Yeah.
Yeah. Now we just need to fix the supply chain.
Well, that's a whole other conversation and video, and one that's probably beyond my pay grade. So
yeah, me too.
I don't know how to fix the shortage of everything, but so let's talk about points. We were talking about that a little bit offline, people using points, utilizing points. Explain, because points can be an ambiguous concept to a lot of people. You know, if they're not a mortgage lender or not in real estate, not doing this day to day. So explain to everybody what points are, how they work, when to use them.
Yeah, it's an interesting conversation. I actually was looking at my other monitor because I wanted to pull up kind of a real life example so that I had numbers for you, because every scenario is different. So typically people just think 1 point, right? 1 point basically means if you have a loan amount of 500,000, let's just use an even number, 500,000, 1 point will cost you $5,000. So but it doesn't have to be an even point. So 1 point can be the difference of, like, I'll use, you know, like a real example today. 1 point can be an example of, for instance, I just priced a borrower on a refi, rate and term refi, on a 25-year amortization term today, 25-year, without paying any points, no points at all. It's a 2.725 kind, you know, like around the 2.7 rate. But if they wanted to buy the rate down, so that's what points are. You buy the rate down. It's a legitimate buy down. It's really funny, Mike, because a lot of people actually think if I charge points, you know, and it's not, it's a legitimate buy down, that I'm making more money, right? I'm increasing my commission. But back in 2008, they kind of did away with that, right? They completely changed the structure of, I don't know about for you guys, but for the way loan officers get paid. So when you pay points, you're legitimately buying the rate down. And in a situation of today, if this borrower really wanted to pay points, they could pay not a whole entire point, but if they didn't want a rate in the 2.7s, they could get a rate in the 2.3 range and pay 0.7 points. So on that same $500,000 loan amount, if you were to pay 0.7 points, not a whole point, that'd be $3,500.
$3,500, yeah.
Now, is it worth it for you to pay $3,500? So 1,747 minus, let me just do this calculation really quickly. In this situation, it would save you close to $70 a month.
Mm-hmm.
So, you know, it'd be a little over 4 years,
Mm-hmm.
right? To pay that investment off. If you're going to stay in the home more than 5 or 10, it definitely is beneficial for you to save. And not only that, with the lower rate, I can't calculate right away what the mortgage interest savings would be, but you'd also be saving tremendously on your mortgage interest, not just on the principal and interest payment.
Right.
So I have a little analysis. I don't know if you've seen it, Mike, the little bit.ly, the little link where you can click on and see an analysis on the amount of mortgage interest savings, the cumulative mortgage interest savings with the different rates associated.
No, I don't think I've seen that.
I'll send one to you just so you have an idea of what it looks like, but that always helps my borrowers determine whether they should buy the rate down, pay any amount of points to buy the rate down, and what the cumulative mortgage interest savings is for them. And it has a timeline, so they can take the little toggle, the little diamond toggle, and let's say they know they're only going to stay in that home for 7 years. They can take it to 7 years and they can see, well, what kind of mortgage interest are we going to be saving? Wow, we're going to be saving that much. Then it does make sense for us to buy the rate down.
Right.
Points.
Yeah, definitely send that. We can include that link when we post the video and share the video too. So people,
I'll send it to you.
Absolutely.
I'll send a sample.
Yep.
Not anybody's real scenario.
Yeah. So just in summary, just for everybody, 1 point is 1% of the loan, not the purchase. So if you're buying a house for $600 and you're borrowing $450, it's 1% of the $450,000, which is $4,500
of the loan amount, not the value or the purchase price. Correct.
Yeah. And then you can, like you said, you can do a half point, 3/4. You know, it doesn't have to be just 1 point. The point can be fractioned off. So
it's normally, Mike, always going to be fractioned off because it's based on the margin or the pricing on the rate. So it's never going to be very seldom have I seen it be an even 1 point, you know, but if that's the goal, I can plug it in that way and then I can see what the rate would be with exactly 1 point.
Right.
But yes, always on the loan amount, never on value.
But what you're saying is usually the optimal savings isn't one. You could always do a 1 point, but that's usually not the optimal savings. The optimal savings a lot of times is 0.6, 0.7, something like that, like you're talking about.
Right.
Yeah.
And sometimes it's really interesting because sometimes my borrowers have a rate in mind.
Mm-hmm.
right? And for instance, you know, maybe they have a rate of, I'm just going to say 2.75 or whatever. You know, if they have that rate in mind and they're really stuck on that rate, then I will focus on that rate and I'll give them a couple different options. But that rate, you know, it might be a 0.54 points buy down.
Yeah.
Versus, you know, you know, people understand the 1 point. They'll go, what can we get for 1 point?
Right.
So I have to kind of educate them.
Yeah. Yeah, it's a nice even round number, but a lot of times, yeah, there's some other fraction of a point that makes more sense. Yeah. Okay.
Typically. And then on the flip side of that, you know, we did talk a little bit offline about this. On the flip side of that, so what if you don't want to buy points? I have clients where I actually, you know, the flip side of that is I actually pay their closing costs.
Right.
So, you know, paying points is to get the lower rate.
Yeah.
Right. Typically, that's the goal. Paying closing costs typically bears a higher rate. But if I can give you a lender credit towards all your closing costs and you can retain your funds for maybe your home needs renovations or cosmetic repair, or maybe you need to buy new furniture. You don't want to sleep on the floor, right? Or an air mattress. That's the flip side of that coin. I have the ability to do that as well, typically with government loans, right? FHA, VA, USDA.
Yeah.
Not so much with conventional or jumbo.
Okay. Okay. Well, what else is going on?
I mean, not a whole lot's going on. We are hearing about the unemployment numbers. They're getting better. You know, as far as the mortgage industry, I still have, as we mentioned the last time, a lot of clients that are taking advantage of the equity that they have. There's a lot of people nationwide that have a lot of equity. And again, I'm going to go back to talking about, you know, the naysayers or the media stating that this appreciation cannot keep going up, right? You and I talked about it. It's pure economics. There's not going to be a bubble burst. And even if there were, like in 08, even if it burst, people have so much equity that they would basically just put their homes on the market.
Right.
We wouldn't be in a short sale situation.
Right.
We probably wouldn't even be in a foreclosure situation.
Yeah. And when we talked about that, and, you know, there are huge hedge funds that would love to buy up a lot of that or all of that inventory. But I see that the values going up is partially appreciation and partial price increase. And I know that sounds like the same thing, but it's not. Like, and what I mean by that is everything is going up. So yeah, like, wow, I can't believe this house is $1 million. It was $750 3 years ago. Yeah, well, absolutely. But $1 million is not what it used to be. Outside of housing, $1 million is not what $1 million was 3 years ago, 5 years ago, even 18 months ago. So,
well, I mean, actually you bring up a good point, Mike, because there was analysis done yesterday where they looked at 2006 numbers, right? I sent you the chart. Why is there so much demand for homes right now? Because back in, I don't remember the years, but back in the 80s, when there was a huge baby boom, right? There were a lot of babies born. Those people are now millennial age, and that is what is driving our market right now. So we have a huge influx of people that were born in the 80s, and they're all millennials right now, and they want to buy homes, and that's where our demand is coming from. It isn't that, and yes, there is lower supply, but there was a baby boom back then. So those people are wanting to buy homes. And then they did an analysis of what was different between 2006 and now. 2006 was 2 years before the bubble burst, right? Before the complete decline in the mortgage industry.
Yeah.
And the biggest difference was that in 2006, people made less. So if you look at what the value of your dollar and what you're making, rates were much higher. They were in the 4 to 5% range, right? Yeah. So rates are in the 2 to 3% range. So with people making more income and rates so much lower,
Yeah.
they can actually afford to buy more home.
Yeah, affordability is much, people think affordability is, kind of gone out of control here. And, compared to a year or two ago, not really at all, because rates are even lower. But yeah, maybe compared to like 5 years ago, or certainly like, coming out of the recession, like in 2010, 11, 12, yeah, affordability is lower, but it's affordability is a decent amount higher than it was back in 2005, 2006, exactly what you talked about, where, just wages and people are making more now in 2021 than they were in 2006. And interest rates are 2.5%, 3%, as opposed at that point they were, if you were below 5, that was a great rate. I mean, rates were 5, 5.5, maybe 6%, depending on, exactly when you're looking for a time frame. So
yeah, and you're not making as much money, so you can't afford as much home. And yeah, homes might have been, I mean, lower. I don't think they were that much lower, because remember, that was a market that was also increasing, and homes were flying off the market.
no,
right?
when adjusted for inflation, home prices at that point were not lower than they are now. When you adjust for inflation, they were not. So if you're looking at them in actual nominal dollars, yeah, they're lower. They were lower then than they are now. Sure.
Yeah.
But, that's inflation over time, and then certainly inflation over the last year, 18 months.
Yeah.
Oh.
So I think people need to understand that part of this whole, and going back to what you were talking about, why are there still people who didn't refi? I wanted to mention this one other thing. Not only maybe you were unemployed, but also I have some borrowers that were in forbearance.
Yeah.
So, back last year, you could go into forbearance, which means you could let your lender and even your credit card companies and your student loan creditors know that you could not afford to pay, even if you could. And so they put your payments on hold. We could not refinance a loan if you were in forbearance. You had to come current. The funny thing about the forbearance is I have a lot of borrowers who just went online and queried what it was with their bank, their creditor, their lender. And for whatever reason, those lenders put those people on forbearance on the credit report. In other words, my borrowers were still making their payments, but none of those payments were being reported on the credit report, because all they did was query that, and the lender,
that was it. Once
they're interested, we're putting them on forbearance.
Yeah.
It was really a hassle to try to get people off of that. But that's a lot of reasons why people are refinancing now today, because now they're out of forbearance. So they're able to.
Yeah, well, I'm glad they got through that and
got
out of forbearance and back into some normality. So okay.
Some normality.
Yeah. Okay. Well, let's wrap this up. This was a short and sweet one, but informative. The point discussion certainly, and we'll come back next month, and there'll be all sorts of crazy new mortgage news, or there won't be. And either way, we'll have a fun conversation. So.
Yeah.
But okay. Well, thanks, Momi.
Thanks, Mike.
Yeah.
It's always a pleasure.
Likewise. So we will wrap this up. Take care, everybody. We'll see you next month. Reach out to Momi and check out her little link if you want to run some different scenarios on points. So, all right. Take care.